Welcome back. The Fed is poised to hold rates steady today, and our next guest says that move could be the first step in a policy mistake that could spoil the chances of a soft landing. But as of now, he sees a 50% chance of the market getting out relatively unscathed. Joining me now is Mohamed El-Erian, Allianz Chief Economic Advisor and former PIMCO CEO. Mohamed, great to see you. Welcome.
Thanks for having me, Kelly.
Do you think they should cut today?
I do. I'm in the camp that they should cut today because the economy is weakening much faster than they realize.
What do you point to for that?
So first, I listen very carefully to what the companies are saying, and whether it's Starbucks, McDonald's, PepsiCo, you can go down the list. They're all pointing to softening demand and a loss of pricing power. Secondly, I look at the cracks in the labor market, and I worry about that. And then I also look at what's happening to the lower segment of the consumer, and there's real pain there already. So when you put these three things together, there is a risk that they build on each other, and next thing you know, you are very close to a recession.
Yeah, well, you know how I know we're close is because I'm finally starting to feel bullish. So that must be a sign, because I have to tell you, I've been waiting. The leading indicators have been inverted for like 2 years, right? We know that the classic signs have all been pointing towards a slowdown, ISM manufacturing and so forth. But then jobless claims are holding in there. Yesterday, I mean, the number of job openings rebounding the way that it did, consumer confidence, okay, you could quibble with some components of it, but overall it's improving. I don't know. And yet Michael Dardis says he's in your camp and says, kiss the soft landing goodbye. A harder one is coming.
So I'm not kissing it goodbye. I'm saying a 50% chance. Look, we are totally dependent on the labor market. Most households have run down their pandemic savings. Too many have maxed out their credit cards. So if we lose labor income, then we are in trouble. So yes, the labor market becomes absolutely critical, but there are no other spare tires right now in this economy.
But I wonder if the labor market looks fine, right? I mean, the best leading indicator we have, jobless claims, it's pretty tame. Now, it's not going to break out until we're on the precipice of that slowdown. Yes, the unemployment rate has risen, but we also have some structural things going on with this immigration surge. So, if it keeps rising, okay, grant that, but I respect Claudia Sahm for saying in defiance of her own indicator that maybe it's different this time because of some of those factors.
And it could be. It's a balance of risk, ultimately. So on the inflation side, we've made progress, and today's statement will welcome further progress in reducing inflation. I think the inflation rate will settle between 2.5% and 3%, where most people would view this as price stability. Most would view it as consistent with anchored inflation expectations. So that side of the mandate, if you don't over-obsess with just a single number, 2%, is fine. It's the other side of the mandate that's becoming more risky. And you'll see this again today. I suspect Chair Powell in his press conference will seek a much more balanced risk and bring up the risk of the employment mandate being threatened.
Yeah. No, I wish we could know Friday's report today. I mean, that's always the case with Fed meetings, but especially right now. Is it possible that the immigration surge is throwing a wrench into these figures? In other words, that the reason why the unemployment rate is rising is just because we're not absorbing all of those new workers and the potential GDP is higher than we realize?
No, it could be. And that surge has been a positive supply shock. There's a question mark as to how long it's going to last. Some economists think we've had the best of it. But it has been, this has been an exceptional economy. U.S. economic exceptionalism has been incredible. We got numbers that Germany slipped into a negative GDP growth recently again. The U.S. has been really the star performer, and we don't want to ruin this.
I completely agree. And I'm sure you could say, look, a couple of cuts on the margin probably would do the most to support the continued expansion. So you would say if they don't cut by, September, then that would definitely be a mistake.
Yeah, whether they cut in July or September won't make that big a difference. The problem is this is a highly data-dependent Fed. It's overly data-dependent. And high-frequency data, as you know, Kelly, is noisy. We saw today with the Eurozone inflation number going back up, they could get a bad inflation print. And if they are overly data-dependent, then next thing we know, they don't cut in September, and then they'll look at November. And by that time, you have the lagged effects of the interest rates, you have the higher for longer, and you have already the weakening structure, and then you really start to worry. That's why, look, I would rather they cut today, I know they're not going to cut today. If they cut in September, it's not in the end of the world. But if they get derailed from September, then the 50% chance of a soft landing goes down quite a bit.
Yeah, and you could see that maybe a couple. So if they're not data dependent, what are they? How else do you make a decision?
So you should be forward-looking as well. You never drive a car looking just at the rearview mirror. You also look at the road ahead. And you have quite a bit of indicators suggesting what the road ahead looks like. They got burned badly in 2021 when they did take a look forward and ended up with this transitory inflation narrative that really hurt them. So they've been very cautious, but they've become overly data dependent. So what would be good for the US economy is for them to be more balanced between backward looking and forward-looking indicators.
All right, it's a tricky thing because even the people looking at that are having two different conclusions right now. Mohamed, thanks for being clear in where you stand. It's good to see you this afternoon. Appreciate it.
Thanks
Mohamed El-Erian from Allianz. As mentioned, Claudia Sahm will be on Power Lunch next hour. After the Fed decision and before we hear from Chair Powell, we'll get her thoughts on what this all means for the economy. And that's it for The Exchange. We're just moments away from the rate decision coming at 2 p.m. Eastern and Chair Powell's press conference at 2:30 p.m. I'll see you on the other side of this quick break. Welcome back to Power Lunch. We're just moments away from Fed Chair Powell's press conference. We often see the bigger moves based on what investors hear or don't hear from him versus just the decision itself, which we already have. Let's bring in Claudia Sahm, New Century Advisors chief economist, creator. Oh, we have the same kind of wardrobe vibes, too. Creator of the Sahm rule, the recession indicator. She was among the 3 members of our mock Fed panel who voted for a cut this month. I was just reading your latest missive, Ms. Sahm, and it's quite clear. You say cut. So what do you want to hear from the chair?
An explanation of why they didn't cut. Right, like the case is there. The case is there on the inflation data, both the data in hand, some of the forward-looking inflation data. Right, we're at 2.5% PC inflation year over year, and to be calling this some further progress, right? So, like what is it they're looking for? I think the bar is getting set pretty high, and that really doesn't make a lot of sense. The Fed needs to start that process back gradually to normal, which means gradually reducing interest rates.
There are, as we've been debating this past hour or so, there are viewers and Americans who are concerned and think this is all about appeasing Wall Street, and they're liquidity junkies and they just want lower rates, and it's self-interested and it's not in the interest of the average person. What would you say to that?
The Fed's mandate, the one they're given by law from Congress, is low inflation and low unemployment. And that is their focus. And that's, the tools they have. Interest rates aren't necessarily the perfect tool for that, but that's what they're aimed at. And that is what they have to focus on. And exactly how this affects markets it's important, but it is not the Fed's duty. And for Americans, having jobs and having stable prices, right, that's not appeasing Wall Street. That's like putting us on a good growth path. And then the Fed should be out of the way. They should not be big in the discussions about what's long-term growth, what's, the productivity. They're just trying to get us out of what has been a very rough 4 years. And then step aside and let the real economy get going.
If you were to ask Chair Powell the very sort of pungent question that I sense is on your list, what the hell are you waiting for? What do you think his answer would be?
More data. I understand the Fed. They have a very tough decision to make. And the rules of thumb that we often use in thinking about monetary policy, thinking about the economy, they don't make a lot of sense, right? You think back just 2 years ago in the summer, that was Powell's Jackson Hole speech, there will be pain, right? To get inflation down, it is likely there will be job losses and less growth. Fast forward 2 years. I mean, this has been hard at times. There has been no recession. There has been no widespread pain, and inflation came down a lot. So then what does that tell you in terms of what does it take to get that last mile? How important is it to pull back, start easing the interest rates? I get it, it's tough, but they've got to make a decision.
In the minute we have before he's likely to come out, though, what if the economy isn't as weak as we think it is. Having been bearish for the last 2 years, at some level, you have to acknowledge this immigration surge means that potentially that's the reason the unemployment rate's been going up. You've seen this whole debate going back and forth about it. GDP just came in better than expected last quarter. Jobless claims still look fine. Job openings rebounded last month. I don't know. Maybe we can handle rates higher than we think.
We didn't need a weak economy to get inflation down. We don't need a weak economy to get that last little bit out of inflation. So that's where we've got a lot of this growth, the productivity, the labor supply, like all those places are in place. We do not have to be afraid of a good economy, right? If the inflation job is done or we're on that glide path, it's okay. Like the Fed can start stepping aside. It's not about them.
So did you hear, as many of the other commentators you've had on, did you hear the Fed really setting up a rate cut in September?
Yeah, I mean, this is about as good as the doves could want for a statement. There was a lot of red ink, and I can only imagine how many hours and hours of painstaking negotiation were over every word.
We're going to have to break in there, Claudia.